Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically contingent liabilities. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. In the traditional sense, contingent liabilities are the potential liability of uncertain events in a future period. For example, a small business may have product warranties or a pending lawsuit whose outcome is uncertain. Depending on the probability of the event happening, a liability may be recorded as an accrued but unpaid expense or listed as a footnote in the financial statements. Now, another important way to view contingent liabilities is to those unknown, underestimated, or misunderstood liabilities that a debtor has that may affect his relationship with a given creditor. Creditors can fail to fully understand a debtor's actual liability profile, and debtors may fail to fully disclose their actual liability profile. Creditors can be surprised to learn that other debts the debtor has that he was not fully aware of at the loan origination. Call that a contingent liability. Debtors don't always disclose their full financial picture in their financial statements. Nondisclosure or incomplete disclosure of contingent liabilities is a major no-no. An individual debtor may be a general partner or investor in a certain unrelated large commercial real estate development in another state even. Assume that he personally has joint and several unconditional liability or 100% liability for 100% of the entire underlying, let's say, $10 million loan, even though he only owns, let's say, 40% of the asset being financed. Intentionally or not, the debtor may disclose to a given creditor his 40% interest or $4 million of the CRE liability, and not disclose his actual 100% or $10 million liability for the entire debt. He may only disclose a 40% interest in the net profit too, and the creditor may think that there is only a 40% liability interest. But he fails to understand that he is 100% personally liable on a very large mortgage debt. If that large CRE project fails and there's a material shortfall after the collateral is liquidated, that creditor will likely pursue a deficiency judgment against the debtor. That pending litigation and eventual judgment could be considered a contingent liability that none of the parties gave enough attention to. In an economic downturn, things like this can bankrupt the stakeholders, and other lenders may not even be fully aware of these risks. Finally, maybe a debtor is a cosigner on another loan not listed on his personal financial statement with another creditor. If the loan goes into default, the creditor may pursue collection against the cosigner debtor, perhaps coming as another surprise to the original creditor. So why is contingent liability risk important to you? Surprise, surprise, surprise. A contingent liability can sink a perfectly sound ship. A perfectly good lending relationship, in other words, can be upended when a debtor walks into the creditor's office one day and drops the keys on the desk and says he's effectively bankrupt. The creditor would be very surprised and ask, how could that be? The credit file shows a strong financial statement, tons of abundant liquidity, and even strong cash flow for debt service coverage. Yes. And now the debtor is essentially bankrupt? The creditor thought he had a customer that was a seasoned investor. So what could possibly have gone wrong? Answer: imagine a borrower told this lender that he was a party subsequently or recently told a lender that he was a party to a large medical center building in another neighboring state and the project failed. The underlying mortgage went into default earlier in the year. The creditor sued the partners for very large sums and was awarded a $2 million judgment against the debtor, this guy's borrower. The debtor would be unable to hide or shield his liquidity and assets, And if he did, the preferential treatment of those asset transfers would likely be unwound by a bankruptcy trustee anyway. So the guy's borrower, he's stuck. And the original creditor, didn't even know about this contingent liability. So the debtor's liquidity was effectively wiped out on account of the recorded judgment. And now the current creditor is sitting there in a state of disbelief, looking at the keys, right? Realizing that the collateral on the debtor's loans was the only remaining viable repayment source. Maybe the creditor could exercise the right of offset on deposits with the creditor. But that too may be subject to further review and recapture if bankruptcy were ultimately filed. Such surprises do happen. Next, none of the stakeholders should be surprised, because that's not good lending. The key takeaway here is the fact that when financial deterioration occurs, the financial status of the debtor may take an unexpected change. The business and personal financial statements on file may, in reality, take on a whole other look when push comes to shove and unknown contingent liabilities are identified. You need to be exceptionally clear with your creditors as to your full debt profile, and be sure to explain all legal obligations in sufficient detail so there's no misunderstanding, including any contingent liabilities. Even if the creditor doesn't require or ask for full copies of every legal entity you have an interest in, you should still provide the same to the creditor so he can see the entire financial picture. Thank you for joining us. Today we covered the creditor tool, Contingent Liabilities, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences. Any questions and impacts and recommendations you have with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.